Okay, hello students. Welcome to my class. This is Professor Vincent Osaya, and this is the presentation of part 2 of chapter 21, Accounting for Leases. We left off at this point in part 1 presentation. We are still talking about how to recognize or how to account for transactions or lease transactions from the standpoint of the lessee, not the lessor now, because that is the first part of the whole chapter, accounting by the lessee. So, in part 1, we talk about the fact that we have two types of lease. We have the operating lease, we also have the capital lease. Again, from the standpoint of the lessee, not from the lessor. So, moving along, we said that for a lease to be classified and recorded as a capital lease, one of these four criteria has to be met. And FASB identified the four criteria as follows. Number 1, the lease transfer ownership of the property to the lessee. What does that mean? That simply means if you look at the lease contract, there is a clause that says at the end of 10 years or 15 years of the lease term, however the case might be, the equipment or the truck, whatever, the ownership of the property or the equipment can be for the lessee. So ownership is being transferred to the lessee. Number 2, the lease contains a bargain purchase option. What does that mean? Bargain. The price of something that is being offered to you is so good, we say that this is a bargain, you can't pass this by. So here in the clause of the contract, there's a bargain purchase option giving the lessee the option to buy the equipment or the property at the end of the lease term. For example, the amount is so minimal and so little, it is very likely that the lessee will exercise its option to buy that equipment. So we said that if the lease agreement contains a bargain purchase option, it is a capital lease. Number 3, we said that if the lease term is equal to 75% or more of the estimated economic life of the leased property, it is a capital lease. What does that mean? The lease term, that is the number of years that you are leasing equipment, is 8 years. The estimated useful life of the equipment is 10 years. So divide 8 by 10, that will give you 80%. So if the lease term is equal to 75% or more of the estimated economic life of the leased property, it is a capital lease. Number 4, if the present value of the minimum lease payment, excluding executory costs, equals to or exceeds 90% of the fair value of the leased property, it is a capital lease. What does that mean? 90%. So we're going to talk more about that in a minute, the 90% rule. One thing that I want you to be aware of right here is the fact that if one of these four criteria is on the lease agreement, we consider it as a capital lease. Again, we are still talking about lease from the standpoint of the lessee, not the lessor at this point. So moving along, let's take a look at this diagram, helping us to determine whether a lease should be considered and classified and recorded as a capital lease. Leases that do not meet any of the four criteria are accounted for as operating lease. So if the lease does not meet any of these four criteria, it is an operating lease. So you can go through this diagram. This diagram pretty much help you to go through the approach of determining whether it is a capital lease or not. So for example, we start with the lease agreement here. The question here is there a transfer of ownership? If the answer is yes, stop, it is a capital lease. If the answer is no, then the next question is there a bargain purchase option? If the answer is yes, it is a capital lease. If it's not, then the next question is the lease term 75% or greater of the economic life? If it is yes, it is a capital lease. If it's not, then the next question is the present value equal to or greater than 95% of the value? If it is yes, it is a capital lease. If it is not, it is an operating lease. I know I went through that very fast. I'm going to talk about these 4 criteria a little bit more in details. So here they are again because they are very important. Number 1, transfer of ownership test. We talk about that. If the agreement said, at the end of the life of the team, the property can be all yours, or you can keep the property, don't even bother to return it to us. That is the transfer of ownership test. Number 2, bargain purchase option test. I explained that to you earlier. In other words, you have the option of purchasing the property as such a good bargain, it is likely that you are going to exercise it. So if you have such a clause, it is a capital lease and it should be treated as such. Number 3, economic life test. That is easy, meaning that if the term of the lease, like I just explained to you, you are leasing the property for 8 years, the useful life or the estimated useful life of the property is 10 years, that is 80%, then it should be considered as a capital lease. Now, let's take a look at the application of the rules that we have just talked about. Take a look at this illustration. Home Depot leases a JPC for 2 years at a rental of $100 per month per computer, and subsequently can lease them for $10 per month for computer for another 2 years. The lease clearly offers a bargain renewal option. The lease term is considered to be what? 4 years. Now, the lease term is considered to be 4 years. Now, let's take a look at the fourth criteria, which is a little bit more complex than the first 3. That is the 90% test. The 90% rule says that if the present value of the minimum lease payment is 90% or more of the fair value of the property, it is a capital lease. Now, so let's take a look at the terms you need to know. You need to catch this. Number 1, let's take a look at the minimum lease payment, because we say present value of the minimum lease payment. Now, what is minimum lease payment? You need to catch this. Minimum lease payment consists of 4 things combined. Number 1, minimum rental payment. Number 2, guaranteed residual value. Number 3, penalty for failure to renew or extend the lease. Number 4, bargain purchase options. Now, you need to stop right here. Listen to this very carefully. Remember, if you have a lease, what do? You make monthly payment or quarterly payment to the lessor. Okay? So that is the minimum rental payment. It is different from the minimum lease payment. So I want you to know this. This is very important. The minimum rental payment is not the same thing as minimum lease payment. The minimum rental payment is the normal regular monthly payment that you pay. That is the minimum rental payment. But then you add these 3 items, if they are applicable, that will give you the minimum lease payment. So let's back up. So what are we saying here? If the present value of the minimum lease payment is equal to 90% or more of the fair value of the property, it is a capital lease. Now, when we talk about present value, remember now, the monthly payment that we are going to be paying over the next 1 or 2 or 5 years, they are all future amount. So we need to compute the present value. We have already talked about the time value concept of money in order for us to determine the 90% rule. So here are some issues you need to know here. Insurance, maintenance, taxes relative to the lease agreement, we call those executory costs. We exclude them from present value of the minimum lease payment. Now, having explained that, we need to actually see how this is applied, and we are going to take a look at that in a minute. So let's take a look at the capitalization criteria. What are we talking about here? Remember, we said present value of the minimum lease payment. To compute present value, we have to take into account the interest, the discount rate of the interest rate. The question is, how do we determine the interest rate? So here is additional rule that you need to know. Number 1, the leasee, again, we are talking about the accounting treatment from the leasee standpoint. We said that the leasee computes the present value of the minimum lease payment using its incremental borrowing rate. What do you mean by incremental borrowing rate? That is the interest rate that the leasee ordinarily would have been able to, that the bank would have charged the leasee if the leasee was borrowing money from the bank for whatever reason. So we call that the incremental borrowing rate. So we are going to use that interest rate with one exception. If the lessee knows the implicit interest rate computed by the lessor and is less than the lessee's incremental borrowing rate, then the lessee must use the lessor's rate. Whoa, what are we talking about here? Listen to this. It's not that confusing as it sounds. Just listen to this carefully. You are the lessee. If you go to the bank, ordinarily the bank will charge you 10% interest rate to borrow money for whatever reason. Now, you have to use that interest rate when you are computing the present value of the minimum lease payment. Now, either you use that or you use the interest rate that the lessor is indirectly charging you in this agreement, because when the lessor leases an equipment for you for $500,000 over 10 years period, trust me, the lessor is also taking interest into consideration in your monthly payment for 5 years, even though you don't know it. So if you know the interest rate that the lessor is using for this deal, and if that rate is lower than what you would have been able to get from the bank, then you need to use that rate. Isn't that interesting? So you have to use the lower of these two rates. So moving along. Now, we are still talking about accounting by the lessee. So we have to recognize assets and liabilities. So we said that if a lease is a capital lease, and that is the second type, then we need to record it as if we actually bought it. We are not buying it, but we are recording it as such. Because when you buy an equipment, what do? You recognize the asset in your books and you record the related liability. So that is what we are doing here. So assets and liabilities are recorded. However, take a look at this. At the lower of another rule that you need to know, there's a bunch of rules relative to accounting for leases. The lower of what? The present value of the minimum lease payment, excluding executory costs like we discussed, or the fair market value of the lease asset. So what are we talking about here? So here you are going to recognize asset as if you are buying it, and you are going to recognize the related liability. But you have to record these two at the lower of these two amounts: the present value of the minimum lease payment or the fair market value of the lease asset. So this would be a very good place to cut off part 2. So we are going to take it from there in part 3.